Welcome back to the Deep Dive. So glad you're joining us again. Today, we're diving headfirst into, well, the very digital DNA of modern business. We're talking enterprise and accounting information systems.
Mm,
Now, you might hear accounting and think, dusty ledgers, maybe endless spreadsheets.
right, the old school image.
Exactly. But forget that. We're talking about these incredibly sophisticated, often invisible systems that are actually powering everything from like your daily coffee purchase tracking to the massive global supply chains behind the products you buy.
It's absolutely fundamental.
It's all about data, decisions, and some seriously intricate tech. So our mission today is pretty clear. We want to strip away the jargon, really understand how these crucial systems function, why they're so completely indispensable, and how cutting-edge technology is transforming them.
And crucially, the controls.
Yes. And how we make sure we understand the robust guardrails that keep everything honest and secure. Get ready for some serious aha moments today. Let's dig in. Okay, so when we talk about how a massive company, keeps all its ducks in a row, managing everything from sales and shipping to HR and manufacturing, there's often this one central brain making it all happen. We call it an ERP system. But for those of us, maybe like me, who aren't exactly knee-deep in enterprise architecture day to day, what exactly is an ERP, and how does it really fundamentally change how a big company operates?
Yeah, that's the perfect place to start because understanding an enterprise resource planning or ERP system is just key to grasp in modern business. Think of an ERP as the company's central nervous system, or maybe like a master orchestrator conducting the whole symphony. Its defining characteristic really is its ability to support and crucially integrate information across pretty much every single department you can imagine. We're talking accounting, customer management, finance, human resources, inventory, manufacturing, marketing, vendor and management, the whole lot.
Wow, so everything talks to everything else.
That's the goal. The real aha moment here isn't just that it connects departments, it's that it fundamentally shifted businesses away from those siloed operations. Where each department had its own separate data, its own systems, its own version of the truth.
Right, like islands of information.
Exactly. ERP turns it into a truly unified, real-time entity. This integration means data flows instantly. So when a sale is made, boom, inventory is updated. Accounting records the revenue. Maybe even the manufacturing schedule adjusts slightly. All in real time, because they're all pulling from and feeding into one centralized database, usually with a single unified user interface. Now, an ERP can offer individual modules that work independently, sure, but their true power, that comes when these modules are integrated, creating this seamless flow of information. That's what enables, global scale and rapid adaptation that was basically impossible before ERPs became widespread.
That makes incredible sense. It's creating that one single source of truth for the entire company, breaking down those internal information walls. But then we also hear about accounting information systems, or AIS. So how do they fit into this grand ERP picture? Is an AIS just a part of the ERP, or is it something separate altogether?
That's a really crucial distinction and honestly one that often causes a bit of confusion, so it's good we're clarifying it. Well, an ERP system is broad, right, spanning the whole enterprise. An accounting information system, or AIS, is much more specialized. As the name suggests, it focuses specifically on the accounting and financial functions an organization needs. So to answer your question directly, yes, an ERP can, and very often does, include really robust AIS capabilities. In fact, when an AI is part of a larger ERP system, it's usually far more powerful and tightly integrated. It shares data seamlessly with all those other operational departments we mentioned, sales, inventory, HR.
Okay, so it's nested within the larger system, potentially.
Often, yes. Accountants and financial managers are the primary users interacting with the AIS functionality. Its core purpose is pretty straightforward: collect, record, store, and compile all the accounting information. And that includes both financial data, obviously, but also relevant non-financial data, like customer order details or maybe employee labor hours. It does all this using established accounting rules. Then, this processed information is reported out to decision makers across the enterprise. Understanding this relationship is really vital because it clarifies how that foundational financial data, which is truly the heart of any business, flows into and informs the bigger operational picture.
Got it. So if the ERP is the whole orchestra, the AIS is like the incredibly precise, absolutely critical strings section. It has a very specific vital role. And I'm guessing within that strings section, the AIS itself isn't just one big instrument, right? It's probably more like a finely tuned ensemble with distinct parts, each playing a specific role to produce that accurate financial information.
Absolutely, that's a great analogy. An AIS typically comprises three main subsystems or modules. Each has a unique and critical role, and they all have to work together in concert. First up, you've got the Transaction Processing System, or TPS. Think of this as the busy engine room of the AIS. It's constantly running. Its main job is to capture and convert all those everyday economic events, like a customer buying a product or the company paying a supplier, into formal financial transactions. We usually think of these as journal entries. This system processes that raw data and then distributes the information needed to support daily operations. The TPS typically handles three core transaction cycles: the sales cycle, getting money in; the conversion cycle, especially for manufacturing, turning raw materials into goods; and the expenditure cycle, paying money out. So the moment you make a purchase online, for example, the company's TPS springs into action. It translates that event into a structured journal entry and kicks off a chain of necessary updates across their system.
Okay, the workhorse doing the day-to-day recording. What's next?
Next, we have the Financial Reporting System, or FRS. This system is all about aggregation and, importantly, external communication. It pulls together all that daily financial data churned out by the TPS, but it also incorporates information about less frequent but often highly significant events. Things like mergers and acquisitions, maybe major lawsuit settlements, or even the financial impact of a natural disaster. The FRS's absolutely critical role is to ensure timely and accurate regulatory and financial reporting. This is vital for external stakeholders, think investors, creditors, government regulators. It ensures the company meets all its legal and compliance obligations and presents a transparent, accurate financial picture to the outside world.
Makes sense. TPS for the daily grind, FRS for the official story outwards. What's the third part?
And finally, we have the Management Reporting System, or MRS. Now, unlike the FRS, which looks outward, the MRS provides internal financial information. Its whole purpose is to empower management, the people running the company day to day, to make informed decisions and solve immediate business problems. This could involve everything from budgeting and forecasting future performance to performing variance analysis, comparing actual results against what was planned, or maybe conducting cost volume profit analysis to understand how changes in sales volume might affect profitability. The MRS is essential because it provides that granular, actionable insight needed for internal decision-making. It drives operational efficiency and helps shape the strategic direction within the company itself.
Okay, that trio, TPS, FRS, MRS, sounds like the absolute backbone of financial insight for any company. So what's the ultimate goal here? With all this intricate data capture, processing, and reporting across these three subsystems, what are they collectively trying to achieve for a company's financial health and overall integrity?
That's right. Working together, these three AI subsystems aim to achieve 5 really fundamental objectives. You can think of these as the unshakable pillars of financial accuracy and integrity for any organization. First, they absolutely must record valid transactions. That means every single event captured has to be real, legitimate, and actually occurred. No phantom transactions.
Okay, makes sense. Real stuff only.
Second, they need to properly classify those transactions. This means putting them into the correct accounting accounts. Is it revenue, an expense, an asset? Getting the category right is crucial. Third, it's absolutely critical to record transactions at their correct value. No understating revenue or overstating expenses or vice versa. This is paramount for truthfulness in reporting.
The right amount, every time.
Fourth, they must record transactions in the correct accounting period. This is vital for producing accurate financial statements at specific points in time, like at the end of a quarter or the fiscal year. Timing matters hugely in accounting. And fifth, perhaps the most holistic objective, they must properly present the transactions and all related information in the organization's financial statements. This pulls everything together accurately for the final reports. These 5 objectives, working in tandem, are really the bedrock of reliable financial reporting. They ensure that the financial picture a company presents is trustworthy, compliant, and accurate for everyone who relies on it: managers, investors, lenders, everyone.
That's a lot of steps, a lot of data flowing around, and 5 really strict objectives to meet. It sounds complex. How do we ensure that every single step of this financial journey, from the initial event to the final report, is traceable, verifiable, and above all, correct? If there's discrepancy somewhere, how do you possibly pinpoint exactly where it happened in that flow?
That is precisely where the specific logical sequence of events within an AIS and the whole concept of an audit trail become absolutely indispensable. An AIS doesn't just randomly process things. It handles transactions in a very logical, consistent order. And this sequence creates a verifiable chain of custody, if you will, for every single piece of financial data.
Okay, so there's a defined path.
Exactly. It typically begins with transaction data.
Hmm.
This could come from physical source documents like invoices or purchase orders, but increasingly it's coming directly from digital inputs like a customer's online order form submitting data straight into the system. If there are paper documents involved, they're often scanned immediately and then filed away. Or sometimes the digital record itself serves as the original source document now. Next, these transactions are formally recorded in the appropriate journal. Think of a journal as a chronological, time-stamped log of all financial activities as they happen.
Like a detailed diary of money movements.
Pretty much. From the journal, the information is then posted to the general and subsidiary ledgers. The ledgers are where the financial information gets categorized into specific accounts like cash, accounts receivable, sales revenue, etc. After a period, trial balances are prepared. This is essentially a summary of all the debit and credit balances in the ledgers, making sure they balance out. Debits must equal credits. It's a key check.
The fundamental accounting equation check.
You got it. Then, usually at period end, adjustments, accruals, and corrections are entered. These are needed to make sure the books are absolutely pristine and reflect economic reality, things like depreciation or recognizing revenue earned but not yet billed. And finally, after all that, the system generates the official financial reports, like the income statement, balance sheet, and cash flow statement.
Okay, that sequence makes sense, but how does that create the traceability you mentioned?
This entire meticulously documented sequence creates what we call an audit trail. An audit trail is essentially a digital breadcrumb trail. It allows you, or an auditor, to trace any transaction forward or backward. You can start from an original source document, say, that scanned invoice, and follow its path all the way through the journals and ledgers to its final resting place in the financial statements. And crucially, you can also vouch backwards. You can pick a number on a financial report, like total sales revenue, and trace it back through the general ledger, then the sales journal, right back to the individual sales invoices or source documents that make up that total.
Ah, so you can follow the money both ways.
Exactly. This two-way traceability is incredibly powerful in auditing because it provides irrefutable, verifiable evidence. It helps ensure accuracy, legitimacy, and helps detect errors or even fraud. And like we said, in today's digital world, those source documents are often electronic from the get-go. Or sophisticated scanning systems convert paper to digital right at the point of entry. So while you might not see stacks of paper files anymore, the digital record keeping is actually more robust and traceable than ever. Think about a SOC2 engagement, for example. That's where a service auditor assesses the controls of an outsourced service provider, maybe like a company that handles payroll for your business.
Right, like ADP or Paychex.
Precisely. In that scenario, the audit trail is absolutely critical. The auditor needs to be able to track every single payroll transaction from its very origination, maybe an employee's digital time entry, all the way through the processing system to its final output, like your paycheck or the company's final payroll register report. This ensures complete integrity and helps prevent any foul play. It's like having a perfect, unalterable digital record of every single financial move.
That makes it incredibly clear. So these foundational systems, the ERP providing the overall structure and the AIS handling the core financial processing with its subsystems and audit trail, provide the bedrock. But beyond that core structure, businesses have all these daily activities where money is constantly moving around, selling stuff, buying supplies, paying people. That brings us, I think, to what are called transaction cycles. These sound like the real workhorses, the sort of automated assembly lines of a company's financial operations. Yeah, if you imagine a business, you might see the different departments, right? Sales, marketing, operations. But what you don't always see are these intricate, often automated workflows that connect them all, especially when money changes hands. That's what these transaction cycles are all about. They're the core functions handling everything from, making a sale to paying employees, and they're constantly interacting. If you were to actually look at a diagram of these cycles, you'd see these flows. Internal flows, like maybe how the production process updates fixed asset records. And external flows, like sending purchase orders out to vendors or hopefully receiving lots of payments from customers. It really helps you visualize the incredible interconnectedness, like a complex dance of all these processes. Let's delve into some of the key ones.
Exactly right. These cycles are truly where the rubber meets the road for day-to-day financial operations. Let's start with probably the most important one for many businesses, the revenue and cash collection cycle. This is where a company earns its money and, crucially, brings that cash into the bank. The real magic here, enabled by modern AI, is the sheer level of automation and real-time accuracy. Think about it. When a customer places an order, the system doesn't just passively record it. It immediately checks inventory availability by accessing the subsidiary ledger in real time. Do we have this in stock? Instantly. It can even automatically approve or deny credit based on the customer's payment history, again, in real time. The aha here is that this isn't some clerk manually looking things up. It's happening instantaneously as the order comes in. Once that order is confirmed, the system concurrently does several things. It records the sales invoice, it digitally transmits an inventory release order to the warehouse, and it sends a packing slip to the shipping department, all triggered automatically.
Wow, that's efficient.
It is. Then, when the goods are actually shipped, the shipping department digitally enters a shipping notice. That single entry triggers another cascade of updates within the system. Customer credit records get updated, inventory levels are reduced, the shipping date gets logged, and all the relevant general ledger accounts are adjusted. Again, all automated. Later, when the cash receipt arrives, a clerk accesses the system, records the remittance information, and the system automatically closes out that sales invoice, posts the cash receipt to the general ledger, updates the customer's payment record. The key takeaway here is how this cycle builds this continuous real-time audit trail. From the moment the customer clicks buy to the moment the cash hits the bank account. It makes it incredibly difficult for errors or, frankly, fraud to slip through unnoticed, and it gives management immediate visibility into sales performance and incoming cash flow.
That's incredibly detailed and sounds super efficient. Like a perfectly choreographed dance, just like you said, from the initial sale right through to the cash deposit. What about the flip side then? When a company needs to buy things and pay its suppliers, that's just as critical for cash flow and operations.
Indeed it is. That takes us to the purchasing and disbursement cycle. This cycle governs how a company procures everything it needs, could be raw materials for manufacturing, office supplies, or external services, and ensures that its suppliers are paid accurately and on time. When someone in the company requests a purchase, the AIS isn't just a recording tool, it actively helps manage the process. It can automatically verify the purchase request against approved lists or budgets. It might even display a curated list of approved vendors for that item, helping the purchasing agent facilitate competitive bidding or make informed selections.
So it helps control spending from the start.
Exactly. It ensures the company is buying from reputable sources, hopefully at the best possible prices. The system then digitally prepares and delivers the purchase order, or PO, often sending it electronically directly to the vendor. No more paper POs floating around. When the goods eventually arrive, the receiving department logs them into the system, usually just by entering the PO number and the quantities received. This single entry triggers concurrent updates. It updates the receiving report file, it reconciles the quantity received against the open PO, and if everything matches, it automatically closes the PO. It also updates the inventory subsidiary ledger and the general ledger control accounts.
All from that one receiving entry.
Yes. Later, when the supplier's invoice arrives, the accounts payable clerk enters it into the system. The system automatically links that invoice back to the corresponding PO and the receiving report. This three-way match, PO, receiving report, invoice, is a critical control point. Once matched, the system creates a digital accounts payable voucher, essentially approving the invoice for payment. It can even automatically approve the payment based on the agreed terms and set the optimal payment date to manage cash flow. Finally, the system automates the printing and distribution of signed checks, or more commonly now, initiates electronic payments, like ACH. It records the payment in the check register, closes out the vendor invoice in the system, updates the general ledger again, and distributes various transaction reports. The core insight here is that this cycle doesn't just track purchases. It builds in multiple layers of checks and balances from initial request and vendor selection right through to the final payment. This minimizes errors, prevents duplicate payments, and significantly reduces opportunities for unauthorized spending, ensuring every dollar spent is justified, approved, and correctly recorded.
It's really clear how these systems automate so much and build in those controls along the way. But what about, arguably, the most important and often most expensive asset a company has, its people? How do these systems handle the complexities of human resources and payroll, especially in a really dynamic environment where people are coming and going or moving between projects?
Yes, the human resources and payroll cycle. It's absolutely critical, you're right. It's about ensuring people are hired correctly, managed effectively, and paid accurately and on time, all while maintaining compliance with labor laws and regulations. The profound benefit here, especially with modern systems, is the deep integration between the AIS payroll functions and the dedicated human resource management system, or HRMS. This integration allows for real-time updates to employee data to flow seamlessly into payroll. Think about changes in benefit deductions, adjustments to pay rates, managing new hires, processing terminations. All that critical data needs to be accurate and timely for payroll.
So HR makes a change and payroll knows instantly.
Ideally, yes, or with very minimal delay. Many systems also allow employees to enter their timekeeping data directly, perhaps through a web portal or mobile app, in real time. This feeds accurate time and attendance files directly into the payroll system, reducing manual data entry errors. This integrated system then automatically performs complex calculations, allocating labor costs to specific job codes or projects, accumulating direct and indirect labor expenses, calculating gross pay, deductions, and net pay, updating employee year-to-date records, and generating the payroll registers. It also creates the necessary digital journal entries to record the payroll expense and liabilities and automatically updates the general ledger. The real power here is how it tackles complexity, especially in certain industries. Let me give you a concrete example. BuildPros.
Okay, yeah, an example would be great.
So BuildPros is a regional commercial construction company. They manage something like 1,500 to 2,000 different projects every single year. And typical for construction, they face pretty high employee turnover. Plus, their employees are constantly moving between different job sites and projects.
Wow, that sounds like a payroll nightmare if done manually.
Exactly. Keeping track of hours per project, different pay rates, ensuring correct billing to clients, it would be incredibly prone to errors. For BuildPros, having an integrated HR and payroll system wasn't just nice to have, it was absolutely business critical. Their system brought some game-changing solutions. For instance, new applicants complete all their onboarding paperwork electronically before they even become employees. This drastically reduces the administrative burden on BuildPros' HR staff. Employees also have self-service options. They can log in and make real-time updates to their W-4 tax forms or change their benefit elections during open enrollment. Even supervisors can manage tasks like approving time off directly through the system.
That empowerment must save a lot of time.
Huge amounts. And what's truly innovative for BuildPros, given their multiple job sites, is their mobile app. It includes geo-restricted time clocks.
Geo-restricted, what does that mean?
It means employees can clock in and out using the app on their phones, but only when their phone's GPS confirms they are physically located within the boundaries of a specific approved project site.
So no clocking in from the coffee shop down the street?
Precisely. It virtually eliminates time theft and, just as importantly, ensures that labor hours are accurately allocated to the correct project for costing and client billing purposes. As employees clock in using specific job codes, the system automatically assigns their hours to predetermined codes linked back to customer contracts in their database. Then, before the payroll is actually processed, a payroll administrator reviews all the labor allocations to catch any potential errors, ensuring accurate customer billing. Finally, a general ledger export file is automatically created and fed directly into the company's main AIs to record the payroll expense correctly across all relevant accounts. The aha here for BuildPros and for you listening is how this deep integration streamlines everything from onboarding, ensures compliance, prevents potential fraud like time theft, and provides incredibly precise cost allocation, even in a highly dynamic and complex workforce like construction. It's all about getting people paid accurately and on time, while also effectively managing what is often the company's single biggest expense, labor.
That BuildPros example really brings it to life. It vividly illustrates just how integrated these systems have to be, streamlining operations and ensuring accuracy even when dealing with massive complexity. It's a fantastic real-world look at how these systems directly impact not just the company's bottom line, but our own jobs and paychecks. But what about tracking a company's big long-term investments, things like buildings, heavy machinery, computer equipment, or the actual process of turning raw materials into finished products in a factory? How does the AIS handle those?
Those bring us neatly to the production cycles and fixed asset cycles, which are all about tracking a company's tangible output, what it makes, and its long-term capital investments, what it owns. In the production cycle, which is most relevant for manufacturing companies, the AIS is key to managing the entire production process from a financial perspective. When a work order is issued to start a production run, the system immediately records it as a new entry in the work in progress, or WIP subsidiary ledger. Then, as labor hours are logged, from the payroll cycle we just discussed, and raw materials are issued from inventory, documented by digital requisitions linked to the purchasing cycle, the AIS automatically updates that specific WIP account. This provides a real-time accumulating snapshot of the costs going into that particular production run.
So you can see the cost building up as the product is made?
Exactly. The system also tracks standard production costs, predetermined estimates for labor, materials, and manufacturing overhead, MOH. And critically, it records any variances between those standard costs and the actual costs incurred during production. This variance analysis allows management to spot inefficiencies or cost overruns almost instantly. Why did materials cost more than expected on this run? When the production run is complete and the items move from the factory floor to the finished goods warehouse, the AIS automatically closes out the WIP account for that job, prepares the necessary journal entries to transfer the cost, and updates the general ledger inventory accounts. The insight here is that this cycle provides continuous, granular visibility into manufacturing costs. It allows for proactive cost control and gives a clear, real-time picture of the value tied up in work in progress and finished goods inventory.
Okay, that covers making things. What about owning things, the fixed assets?
Right, that's the fixed asset cycle. Here, the AIS acts like a meticulous digital accountant for all of a company's long-term, tangible assets, buildings, machinery, vehicles, computer systems, etc. It usually provides a specific module or terminal interface where the fixed asset accounting group can create detailed records for each asset in a dedicated subsidiary ledger. This record includes crucial information like the asset's purchase date and cost, its estimated useful life, its salvage value at the end of that life, the depreciation methodology chosen like straight line or declining balance, and its physical location.
All the details needed for accounting.
All of them. When a new asset is acquired, the AIS automatically updates the general ledger asset accounts, prepares the initial journal entries, and even creates a depreciation schedule for the asset's entire life. Then, at the end of each accounting period, monthly, quarterly, annually, the system automatically calculates the depreciation expense for that period, updates the accumulated depreciation account, and calculates the asset's current book value, cost minus accumulated depreciation. It then creates the journal entry file for depreciation expense and automatically updates the general ledger.
So depreciation is fully automated?
Largely, yes. And when an asset is eventually sold or disposed of, the system handles that too. It calculates any gain or loss on the disposal by comparing the proceeds to the book value, prepares the necessary journal entries to remove the asset and its accumulated depreciation from the books, and posts those adjusting entries to the general ledger. This entire cycle ensures accurate tracking and accounting for all capital assets throughout their complete life cycle, from the moment they're bought until the moment they're retired. This is absolutely crucial for accurate financial reporting and for tax compliance.
It's truly amazing how these systems track the entire life cycle of practically everything a company produces and owns, from like a single bolt coming off the production line to the entire factory building itself. How does all this incredibly granular, detailed information from production and fixed assets ultimately flow into the overall management of a company's money, its literal cash in the bank, and its financial planning?
That's where the treasury cycle comes into play. You can think of it as the financial bloodstream and the central command center for managing a company's cash and short-term investments. What's particularly fascinating here is its deep integration with all the other transaction cycles we've just discussed. It's the hub. The revenue cycle provides the inflow of capital. That capital is then used to pay expenses through the purchasing cycle, pay employees through the HR payroll cycle, and acquire long-term assets through the fixed asset cycle. This tight integration within the AIS is what allows for incredibly effective and proactive cash management.
So it connects all the money flows.
Precisely. The treasury cycle uses various source documents. Think deposit slips from cash collections, records of checks issued for disbursements, and even real-time financial market data like stock prices or interest rates if the company has investments to post journal entries that directly affect cash balances in the general ledger. A key function here is bank reconciliation. The accounting department uses the bank statements received from the company's banks to reconcile the cash account balance according to the bank with the cash balance recorded in the general ledger. Modern AIs often have built-in control features to automate parts of this reconciliation and help prevent or detect fraud, like flagging checks that cleared the bank but weren't recorded in the system, or vice versa.
That reconciliation is critical for catching errors or fraud.
Absolutely vital. Journal entries are automatically posted for every significant change in cash, keeping the general ledger cash account continuously updated. Crucially, the AIS can generate a variety of sophisticated reports specifically designed to assist the Treasury Department with cash management. These reports provide insights on historical cash receipts, trends in collections versus disbursements, changes in the company's investment portfolio, and even estimates on future interest income or dividend payments. This comprehensive, real-time reporting allows the accounting and treasury departments to effectively predict future cash flows. And that predictive capability is absolutely vital for strategic financial planning, ensuring the company always has enough liquidity to meet its obligations, fund operations, and make strategic investments.
So, the treasury cycle is really about managing that financial bloodstream, ensuring the company's heart, its cash, is always beating healthily and predictably. And finally, after all this sales, purchases, payroll, production, assets, cash management, all of this immense amount of information from every single transaction across all these different cycles, it must all funnel into one grand central accounting record, right? The ultimate summary of everything that happened financially.
Precisely. That brings us logically to the general ledger and reporting cycle, which you can think of as the grand finale, the culmination of all the preceding transaction cycles. This is where all those diverse financial threads we followed are woven together into one single cohesive financial picture of the entire organization. The AIS continuously updates the general ledger, GL, as transactions occur, and as journal entries are posted automatically from all the previous cycles we discussed: revenue, purchasing, payroll, production, fixed assets, and treasury. This means the general ledger isn't some static book. It's a living, breathing, constantly updated record of the company's financial state at any given moment.
The ultimate source of truth, built transaction by transaction.
Exactly. Then, at the end of each designated accounting period, like month end or quarter end, the AIS automatically produces a trial balance. As we mentioned, this report lists every single account in the general ledger and its debit or credit balance, ensuring that the total debits equal the total credits. It's the first major check that the books are mathematically in balance. The accounting department then carefully reviews this trial balance, along with any supporting worksheets or schedules, to determine if any adjusting entries are necessary. These are entries needed to ensure the financial statements accurately reflects the company's financial position and performance according to accounting principles, like GAAP or IFRS. Common examples include recording depreciation expense, accruing for expenses incurred but not yet paid, like salaries earned by employees in the last few days of the month, recognizing revenue that's been earned but not yet invoiced, or adjusting for prepaid expenses.
Getting everything aligned perfectly for the period end.
Right.
That's the goal. Once those adjusting entries are made and posted, and a final adjusted trial balance confirms everything is still perfectly in balance, the AIS then produces the final official financial statements. The income statement, showing profitability over the period, the balance sheet, showing assets, liabilities, and equity at a specific point in time, and the statement of cash flows, showing how cash moved during the period. The system can also generate a wide array of internal management reports at this stage, often showing variances between actual results and budgeted amounts, or comparing performance across different divisions or product lines. Finally, as part of the period-end closing process, the AIS automatically closes out all the temporary accounts, primarily the revenue and expense accounts from the income statement, resetting them to zero so a new accounting period can begin cleanly. It then carries forward the ending balances of the permanent accounts, the balance sheet accounts, assets, liabilities, equity, to become the beginning balances for the next period. This ensures a seamless and accurate start to the new financial cycle. The overarching insight here is how this final cycle takes all the processed data from the entire business, verifies its integrity through balancing and adjustments, and culminates in a comprehensive, auditable, and instantly accessible financial story of the entire enterprise, ready for managers, investors, and regulators.
Wow. So what does this all really mean for the sheer scale and complexity of modern business? We've seen how these interconnected systems manage literally every single financial event in a company, from buying a box of paper clips to paying thousands of employees across multiple countries, all while ensuring an unbroken, verifiable audit trail. But it can't just be about setting these incredibly complex systems up once and then walking away, can it? Surely companies are constantly looking for ways to make them even better, faster, more accurate over time. How does that happen?
Okay, now that we've got a really solid grasp of how these core systems function, handling the fundamental transactions, the bread and butter of any business, let's shift our focus a bit. Let's look at something equally critical, how organizations continuously improve these systems. Because it's not just about having the software, it's about constantly refining the processes that surround that software to get better data, fewer errors, more insightful reporting. It sounds like a constant evolution, not a one-time setup.
That's a critical point, absolutely. Continuous improvement isn't just some corporate buzzword. It's absolutely essential for any dynamic business that wants to stay efficient, competitive, and adaptable. Generally speaking, there are four broad strategies organizations typically employ to significantly enhance their accounting information systems and the processes around them. The first, and perhaps most obvious one today, is automation. This is essentially the use of computer programs and systems to perform repetitive tasks, tasks that were previously done by humans. The big win here is freeing up those human resources for higher value, more complex work stuff that requires judgment, creativity, critical thinking, or complex problem solving. But here's the crucial step that sometimes gets missed. Before you can effectively automate a process, an organization must first thoroughly analyze its existing process. You need to detail every single step, every information exchange, every policy constraint, every bit of required knowledge. You have to truly understand it inside and out before you can effectively design an IT system to replace or augment it. It's not just about throwing technology at a problem. It's about intelligent redesign first.
Right. Automate a bad process, and you just get a faster bad process.
Exactly. Garbage in, garbage out, only faster. The second broad area is shared services. This strategy involves consolidating redundant services within an organization, or perhaps across a group of affiliated companies. Imagine a large corporation with, say, 5 different subsidiaries. And each subsidiary has its own separate HR department, its own payroll processing team, maybe even its own legal counsel for routine matters. Shared services is about centralizing those common back-office functions into one single, highly efficient unit. This unit then provides those services, HR, payroll, legal, IT support, etc., internally to all the different parts of the organization. They often leverage specialized software designed for large-scale batch processing to gain economies of scale.
So instead of 5 payroll departments, you have one bigger, more efficient one.
Precisely. Let me give you a real-world type of example. Consider a hypothetical company, Financial Group, Inc. Let's say it's a financial services company with 3 distinct lines of business: accounting services, tax preparation, and financial consulting. Initially, each of these 3 divisions operated somewhat independently and had its own internal HR, payroll, and basic legal support functions. Their new CEO comes in, looks at this, and sees significant redundancy. So the CEO initiates a plan to consolidate all of these common administrative functions into one centralized shared service function for the entire company. The expected outcome: eliminate all that duplicate effort, streamline processes, and importantly, achieve significant cost savings, maybe slashing annual operating costs by, say, $750,000 in this example. You can easily see how this strategy eliminates a lot of duplicated effort and saves serious money. It's kind of like you centralizing all your personal household bills and subscriptions into one management app for better visibility and efficiency.
That makes a lot of sense, especially for larger organizations. What's the third strategy?
The third major strategy is outsourcing. This is different from shared services because instead of centralizing internally, outsourcing involves contracting specific services or business functions to an external third-party provider for a fee. Common examples include hiring a dedicated payroll service provider, like the ADPs or Paychex as we mentioned, contracting out your customer service call center operations, or maybe outsourcing IT infrastructure management. Often, secure cloud-based systems with robust controls allow these external providers to work almost seamlessly with your organization's internal systems. Now, the potential benefits of outsourcing are clear. It can lead to cost efficiencies, especially if the provider has economies of scale or lower labor costs. It can also provide access to specialized expertise that you might not have in-house.
But there must be downsides too, giving up control.
Absolutely. Outsourcing comes with inherent risks that need to be carefully managed. There are quality risks. The outsourced product or service might be defective or not meet your standards. There's the risk of poor service quality if the service level agreements, SLAs, in the contract aren't meticulously designed and enforced. You might even see reductions in real productivity if the incentive structures aren't properly aligned between your company and the provider. Staff turnover at the provider can be an issue, leading to inconsistency. And if services go offshore, you might encounter language skill barriers, increased security risks associated with third-party handling of your sensitive information, and legitimate concerns about the qualifications and training of the offshore providers. It can also, understandably, create labor insecurity and morale issues for your internal staff whose functions are being moved outside.
Lots to consider there. And the fourth area?
The fourth is a specific type of outsourcing: offshore operations. This is simply outsourcing business function to an external party that is located in a different country, often one with lower labor costs. A classic example is a U.S.-based computer manufacturer having its customer service call center based in India or the Philippines. The most common types of functions that get offshored include IT services, often managed by a managed services provider, MSP, various business processes like call centers, routine accounting operations like accounts payable processing, and tax compliance work. We also see it quite a bit in software research and development, and increasingly we're even seeing offshoring of knowledge processes, tasks that require more advanced analytical skills, like specialized radiologists in one country reading x-rays for hospitals in another country. Each of these four broad strategies, automation, shared services, outsourcing, and offshoring, represents a major lever organizations can pull to make their IT systems and overall business processes leaner, faster, more cost-effective, and hopefully more strategically focused.
Okay, those are the big strategic plays: automating, centralizing internally, sending work outside, or sending it overseas. But within those strategies, or maybe alongside them, there are some really exciting, specific, cutting-edge technologies that seem to be rapidly gaining traction and fundamentally changing how work gets done on a more granular level. It's not just about moving functions around. It feels like there are powerful new tools emerging.
Indeed, the digital toolkit for process improvement is constantly expanding and getting more sophisticated. Let's focus on three key technologies that are truly transforming operations right now. First, let's talk about robotic process automation, or RPA. This is a highly specific form of business process automation. It uses software robots. Remember, these aren't physical robots, but software programs to perform repetitive, rule-based tasks that typically don't require complex human judgment or deep expertise. Think of it as automating the ultimate digital clerical worker. RPA bots are great at things like extracting specific pieces of information from user interfaces, like reading data off an invoice PDF, inputting that data into another system like an ERP, moving files between different folders or applications, or automatically sending out routine communications like payment reminders or executing other pre-programmed routine commands.
So it mimics what a human would do clicking around on a computer for repetitive tasks.
Exactly. It's important, though, to distinguish RPA from true artificial intelligence, AI. RPA excels at following predefined rules very efficiently. It doesn't typically learn, adapt, or provide deep analysis in the sophisticated way that AI aims to. It's more about automating predictable workflows. RPA can manifest in various ways. For instance, while a general web scraping tool might just grab a whole bunch of unstructured data from a website, an RPA bot could be programmed to refine this process, maybe scraping specific data points, validating them against certain criteria, and then formatting them into a structured report. These software robots can interact with many kinds of computer systems just like a human user would. Looking further ahead, even highly advanced applications like the LiDAR technology used in self-driving vehicles, which interpret sensor data to perform human-like driving functions based on complex rules and patterns, could arguably be seen as a very sophisticated form of process automation. As these kinds of sensor and interpretation technologies become more refined and cheaper, their application will likely expand into automating aspects of other human job roles too.
Can you give a more down-to-earth example of RPA in an accounting context?
Sure. Consider a company that wants to use RPA to streamline its accounts payable process. They receive invoices from hundreds of different suppliers, often in slightly different formats, PDFs, emails, etc. Instead of having AP clerks manually read each invoice, extract the key data, vendor name, invoice number, date amount, PO number, and then type it into their ERP system, they decide to implement RPA. Since they deal with a relatively limited number of common invoice layouts from their major suppliers, the company builds a digital library of these forms for the RPA bot to reference. Once trained, the RPA bot can automatically monitor an email inbox or network folder for incoming invoices. It scans each document, uses optical character recognition, OCR, and its programmed rules to identify the layout, extract the relevant data fields, perhaps perform some basic validation checks, like matching the PO number to an open PO in the ERP, and then automatically enters that data directly into the ERP systems database to create a draft AP voucher.
Wow, that takes out a huge amount of manual work.
Exactly. It truly automates those mundane, high-volume, error-prone tasks. This significantly improves efficiency, drastically reduces data entry errors, speeds up the payment cycle, and importantly, frees up the human AP clerks to focus on more complex issues, like handling exceptions, resolving disputes with vendors, or analyzing spending patterns. Second, let's touch on natural language processing, or NLP software. This is a fascinating branch of AI that's all about enabling computers to understand, interpret, and even generate human language, both written and spoken. Its purpose is to allow technology to perform tasks based on natural language inputs, interact with humans in a more intuitive way, or even carry out commands on other devices using voice or text. Now, this is far from simple. Effective NLP requires incredibly complex mapping of various linguistic elements, pragmatics, context, syntax, grammar, phonetics, sound, semantics, meaning, even pitch and tone in spoken language to ensure the NLP program determines the proper interpretation and generates an appropriate response or action.
Right. Like when I talk to my smart speaker at home, hey Google, what's the weather? Or Alexa, play some music. That's NLP in action, understanding my request and doing something. And you're saying that same incredible technology is rapidly coming to analyze accounting data too, allowing systems to understand unstructured text, like contracts or reports. That leads us to neural networks, which honestly still sound like something straight out of science fiction.
They do have that sci-fi ring to them, don't they? But they are very real and becoming increasingly powerful tools in business and finance. Neural networks are a specific type of machine learning technology modeled, conceptually at least, after the complex, interconnected network of neurons that facilitate memory and learning in human and animal brains. Their basic structure usually involves several layers. There's an input layer, which takes in various data points or variables relevant to the problem, maybe characteristics of a financial transaction. These inputs then feed into one or more hidden layers. These hidden layers contain multiple interconnected processing units, often called neurons. Within these hidden layers, a series of mathematical weights are applied to the inputs as they pass through the network. These weights essentially represent the learned importance or relationship between different inputs. The weighted signals are processed by the neurons, often through an activation function, and then passed on to the next layer, or finally to the output layer, which produces the result, perhaps a prediction, a classification, or a decision.
Okay, so data goes in, gets processed through these weighted layers, but where does the learning come in? How do they get smarter?
The true magic and the learning aspect comes from how these weights within the hidden layers are adjusted over time. While the initial weights might be set randomly or based on some prior knowledge, the neural network learns by comparing its output predictions to the actual known outcomes for a set of training data. If the network's prediction was wrong, algorithms like backpropagation calculate the error and adjust the weights throughout the hidden layers in a way that aims to reduce that error on future predictions. So just as the human's response or judgment changes and improves with experience, a neural network's internal configuration of those weights is refined through this iterative process of prediction, error checking, and weight adjustment. This leads to a different, more accurate, and more refined outcome over time, essentially allowing the system to learn complex patterns and relationships directly from the data without being explicitly programmed for every possibility.
And where would you use something like that in accounting or finance?
This learning architecture is crucial for making what are sometimes called fuzzy logic decisions, decisions where the inputs aren't exact or clear-cut, requiring an adaptable, almost human-like inference based on patterns. A very common and powerful application in finance is in sophisticated fraud detection systems. Fraudulent transactions often have subtle, complex, and evolving patterns that are hard for simple rule-based systems to catch. A neural network could be trained on vast amounts of historical transaction data, learning to identify these complex, nonlinear patterns associated with known fraud. Because it learns and adapts, it can become smarter and more accurate over time in identifying new or previously unseen fraudulent activities or anomalies that might signal risk.
So this is where the system actually learns and adapts, becoming smarter and better at its job over time. That's incredible. These technologies, RPA, NLP, neural networks, sound truly transformational. They promise incredible gains in efficiency, accuracy, and even predictive insight. But implementing such potentially disruptive changes, whether it's automating a core process, outsourcing an entire function, or deploying advanced AI like neural nets, must require extremely careful planning and management. You can't just flip a switch and hope for the best, can you?
Absolutely not. That would be a recipe for disaster. No matter what type of system improvement initiative we're talking about, be it large-scale automation, setting up a shared service center, transitioning to an outsourcing provider, or deploying advanced technology like RPA or AI, an organization must manage these system changes methodically and strategically. The paramount goal throughout any implementation is to ensure that core business functions are not disrupted, that data integrity is maintained, and that the intended benefits of the new system or process are fully realized without creating unforeseen negative consequences. Change management is key.
Are there standard ways companies approach these big system changes?
Yes, while there's a whole universe of specific project management and system development methodologies out there, two prominent approaches are widely known and often contrasted: the waterfall model and the agile method. The waterfall model is a more traditional approach. It's sequential and linear. You move through distinct, clearly defined phases, and you generally have to complete one phase before moving on to the next. Think requirements gathering, then system design, then implementation coding, then testing, then deployment, and finally, maintenance. It's like building a house following a very strict, detailed blueprint. You finish the foundation before starting the walls. The Agile method, on the other hand, emerged as a more flexible and adaptive alternative, especially suited for complex projects where requirements might evolve. It's iterative and incremental. Work is broken down into smaller cycles or sprints, often lasting a few weeks. In each sprint, a cross-functional team works on a small piece of functionality, including design, development, and testing. There's constant feedback and adaptation throughout the process.
It's more like building that house in stages, maybe building one room completely, getting feedback, then building the next, allowing for adjustments along the way.
So waterfall is more rigid, agile is more flexible.
It's a good summary. Both methodologies, however, despite their different philosophies, typically include essential phases or activities such as thorough system design, rigorous testing, unit testing, integration testing, user acceptance testing, careful deployment planning and execution, a robust change review process to assess the impact of any changes, and ongoing maintenance and support after the system goes live. Choosing the right methodology, or sometimes a hybrid approach, depends heavily on the specific project, the organizational culture, and the level of uncertainty involved. But the crucial takeaway is that selecting and diligently following a structured methodology is absolutely vital for successful implementation, minimizing risks, controlling costs, and ultimately ensuring that the benefits of these powerful process improvements are fully realized without causing chaos in the meantime.
Okay, we've talked a lot about how these intricate systems work, how they handle vast amounts of data, and how they're constantly being improved with automation and new technologies. But here's the absolute crucial question, the bedrock of it all. How do we know they're reliable? How can we actually trust that the data they produce, the data that drives critical business decisions, gets reported to investors, determines our paychecks, is absolutely sound, accurate, and complete? This brings us, I think, to a foundational concept. Processing integrity. What exactly is that?
Processing integrity is, quite simply, the cornerstone of reliability and trustworthiness for any information system. But it's especially critical in the business and accounting world. At its core, processing integrity refers to a system's fundamental ability to initiate, process, and complete transactions in a way that ensures they meet several key criteria. The transactions must be valid, meaning they are real, legitimate events, accurate, recorded at the correct value, quantity, and classification, completed timely, processed within the expected time frame without undue delay, and properly authorized, meaning they were approved by the appropriate person or process according to company policy. All of this must happen in a way that meets the company's stated objectives for that system or process.
So it's about the transaction being right in every dimension.
Exactly. And it goes a bit beyond just the mechanics of individual transactions. The concept of integrity also extends to ensuring the confidentiality and privacy of all the sensitive data that these systems handle. Think about information that identifies customers, patient health records in healthcare, employee PII, personally identifiable information, or confidential financial account details. Protecting the integrity of that data from unauthorized access or disclosure is also part of the broader picture. In fact, processing integrity is formally recognized as one of the 5 essential trust services criteria, which form the basis for SOC 2 reports. These criteria, the others being security, availability, confidentiality, and privacy, are a set of benchmarks used by auditors to evaluate the reliability and trustworthiness of service organizations, particularly those handling data or processing transactions for other companies. The real aha here, the reason this matters so much, is that without robust processing integrity, even the most technologically sophisticated systems will generate untrustworthy data.
And that bad data leads directly to poor business decisions, potential compliance failures, inaccurate financial reporting, and unfortunately, increased opportunities for fraud or manipulation. Processing integrity is fundamentally the difference between a highly functioning, reliable engine driving the business forward and one that could potentially explode at any moment due to internal flaws. It's all about trust in the output.
Okay, so it's not just about having a system in place, but ensuring that system is built right from the ground up, designed with integrity in mind. What if something critical is just missing in its blueprint? Or maybe a control is there, but the initial design itself is flawed, so it can't actually work properly. How do auditors, like in a SOC 2 engagement, go about identifying those kinds of fundamental design problems in a company system?
That leads us directly into how we identify deficiencies in the suitability or design of controls. The AICPA, the American Institute of Certified Public Accountants, which sets the standards for SOC reports, has a very clear definition of what constitutes a design deficiency. It really comes down to two potential problems. One, necessary controls that should be there to mitigate a specific risk or meet an objective, are simply missing from the system's design altogether. They just weren't included in the blueprint. Or two, existing controls that are included in the design, are not designed properly. Maybe the logic is flawed or the control isn't specific enough, so even if it operates exactly as designed, it still wouldn't effectively prevent or detect the issue it's supposed to address.
So either a missing piece or a badly drawn piece in the blueprint. Yeah.
Exactly. To evaluate this, a service auditor first needs to gain a deep understanding of how management identifies risks and designs controls to address them, their risk assessment process. Then, the auditor meticulously compares the controls that management describes in their system documentation against the relevant trust services criteria, like processing integrity, to see if those controls are conceptually sound and adequately designed on paper. We use these trust services criteria as a structured framework for detecting these design deficiencies. For security, for example, we're hunting for any design flaws that could potentially allow unauthorized access, compromise data confidentiality or system availability, or be easily bypassed. For availability, we're looking for design choices that might create single points of failure or bottlenecks that could prevent data or system functions from being available when needed. For processing integrity specifically, we survey the system's design transaction flows and data validation rules. Are there methods that could lead to untimely completion? Are there pathways that could yield faulty results? Does the design inherently fail to meet the stated processing objectives? For confidentiality, we evaluate how the system is designed to handle and protect designated confidential data, looking for vulnerabilities that could lead to leakage or unauthorized disclosure. And similarly, for privacy, we analyze the design of methods for collecting, storing, using, retaining, and disposing of personal information to identify any potential design flaws that could lead to breaches or misuse.
So you're stress testing the design against these standard criteria.
In a conceptual way, yes. A crucial guide auditors use here is the AICPA's description criteria for a SOC2 report. This provides detailed benchmarks that auditors use to compare against the organization's actual system design documentation. It specifically helps in detecting deficiencies in how controls are suited or designed to ensure things like processing integrity. Two key items that are always under review in this context are the principal service commitments, what the organization promises its customers the system will do, and the principal system requirements, what the system needs to do internally to meet those commitments, that management is required to disclose in their description. Understanding how management describes these crucial aspects helps the auditor assess whether the underlying control design is actually suitable to achieve them. It really is like an architect meticulously scrutinizing the blueprints before construction starts. Are all the essential safety features and functional components actually present in the design? And are they drawn correctly so they can function as intended?
That makes perfect sense. You absolutely have to check the blueprint before you start building, or maybe even after it's built, but before you rely on it. But okay, let's say the system is designed brilliantly. The blueprint is perfect. It still has to be used correctly day in, day out by people and processes, right? What happens if the blueprint is great, but the actual execution, the operation, falls short? What happens when the controls that were perfectly designed just don't get performed correctly in practice?
That's precisely the second major area we investigate: deviations in the operations of controls. The AICPA also has a clear definition for an operational deficiency in a SOC2 engagement. This occurs in one of two situations. One, a properly designed control simply does not operate as it was designed. Maybe a required review doesn't happen, or a reconciliation isn't performed, or a system setting isn't configured correctly. The control exists, but it's not being executed effectively. Or two, and this is equally problematic, the control is performed, but it's performed by someone who lacks the necessary authority or the required competence to perform it effectively. For example, if a junior clerk without proper training or authorization is approving large expenditures, the control might technically happen, but it's not operating effectively because the wrong person is doing it. The underlying expectation, the baseline, is that suitably designed controls, when operated correctly by competent personnel, should provide reasonable assurance. Not absolute, but reasonable assurance that the company's system requirements and its service commitments to customers will be met based on those relevant trust services criteria.
Okay, so how do auditors figure out if these well-designed controls are actually working in practice? You can't just take management's word for it, presumably.
Absolutely not. Verification is key. To determine if controls are operating effectively, service auditors perform specific tests of controls. Our goal is to gather sufficient, appropriate audit evidence about how the controls were actually applied during the period under review, the consistency of their application over time, was it done every time it was supposed to be, and which person or automated process, was actually responsible for applying them. If significant changes were made to the system or its controls during the period, we need to document those changes. If feasible, we might try to test the relevant controls both before and after the change to see if the modified control continues to meet the service commitments effectively. It's also important to note, if we, through other procedures or information received, already identify significant deficiencies in the design or operation of specific controls, we generally aren't required to then perform further tests of the operating effectiveness of those specific, known to be broken controls. There's no point testing something you already know isn't working.
What kinds of methods do you use for these tests?
Our methods for testing controls typically include a combination of procedures, making inquiries of relevant personnel, asking people how they perform the control, what they do if exceptions occur, etc. Reperforming the control ourselves, for example, taking a sample of bank reconciliations performed by the client and doing them again ourselves to see if we reach the same conclusion. Observing personnel actually performing the control procedures in real time, and reviewing relevant documentation, records, and system logs that provide evidence the control was performed, like seeing signed approval forms, system-generated exception reports that were reviewed, or logs showing successful completion of automated controls. The purpose of all this testing is to gather evidence about the actual application of the control, its consistency, the person or system responsible, and also to ascertain whether certain controls are dependent on other controls upstream to function effectively. Control dependencies.
Timing must be important too, right? You need to test controls while the evidence is still fresh.
Timing is absolutely a critical factor. We need to plan our testing procedures carefully, considering when the necessary data or evidence will be available and whether there's a risk of it being overwritten or deleted if we don't obtain it promptly. Testing can sometimes be performed at interim dates throughout the audit period, particularly for controls that operate continuously. Other tests might be performed only at the end of the examination period, or even shortly after the period ends if the relevant evidence, like year-end reports, only becomes available then. We also have to carefully consider sampling when testing controls. We usually can't test every single instance of a control operating, especially for high-frequency controls. So we select a representative sample. The size and frequency of our sampling depend on several factors: how often the control is performed, for example, daily, monthly, annually, our assessment of the risk and the expected rate of deviation, how often we think the control might fail, the length of the testing period, and the nature and reliability of the evidence we can obtain for that control.
What happens if a control just didn't need to run? Like a control for processing new hires, but there were no new hires in the period.
That's a great point. It's entirely possible that some controls simply did not need to operate during the period under review because the conditions required for their operation didn't occur. Your example of a control related to authenticating a new employee's identity is perfect. If there were 0 new employees hired during the testing period, that control couldn't possibly have operated. In such specific instances where the non-operation was due to circumstance rather than a failure of the control itself, the service auditor would typically conclude that this doesn't represent a control deficiency, and they would not need to modify their opinion on the overall operating effectiveness of controls.
Okay, that makes sense. But what about when you do find problems? When your testing shows that controls aren't working as they should, how are those deviations handled?
When we do identify deviations in the operating effectiveness of controls through our testing, we meticulously accumulate documentation of every single occurrence we find in our sample. We then have to evaluate the significance of these deviations. If the number or nature of the deviations is such that we cannot obtain reasonable assurance that the company's system requirements or its service commitments are being consistently met, then the deficiency is considered material. Materiality means it's significant enough that it could influence the decisions of someone relying on the SOC report. If these deviations appear to be the result of, or create opportunities for, suspected fraud, the implications become much more serious. The service auditor must then assess the heightened risk, the risk that management's description of the system is materially inaccurate, or that the operating controls designed to prevent or detect fraud are ineffective. This situation triggers a cascade of potential actions. Intensified discussions with management and those charged with governance, like the audit committee, potentially requesting the company engage legal counsel to investigate, potentially needing to communicate with regulators, depending on the context, and in severe cases where trust is broken or the issues are pervasive, The auditor may even need to consider withdrawing from the engagement entirely.
So fraud takes it to a whole different level.
Absolutely. We also need to understand the nature and cause of any significant security incidents or control failures affecting systems that might be outside the direct scope of our audit, as they could indicate deeper, systemic control weaknesses that do impact the system we're examining. If a significant security breach occurs during the audit period, we have to reassess the inherent risks related to the system, determine if the core system we're auditing was compromised, potentially perform additional audit procedures, and obtain new evidence about the effectiveness of controls following the breach. Ultimately, after considering all the evidence, the service auditor uses their professional judgment to make the final decision on whether the identified deviations, either individually or when aggregated together, are material. If they conclude that the deficiencies are material, then the auditor is obligated to modify their opinion on the operating effectiveness of the controls in the final SOC2 report, clearly stating that the controls were not consistently effective throughout the period.
So it's a really rigorous process with potentially significant consequences if things aren't working right. It's not enough to just design good systems. They absolutely have to work as intended in the real world day after day, and auditors are there to diligently check that. Now, okay, let's try to tie some of this together. Let's talk about a major framework that companies use to actually design and implement these internal controls in the real world, and then connect it directly to one of the most revolutionary and sometimes controversial technologies of our time, blockchain. This feels like where we see how traditional control thinking is adapting, or maybe struggling to adapt, to entirely new digital frontiers. It's where the rubber meets the road between established best practices and potentially bleeding-edge disruptive innovation. Right, let's bring it all together now. We need a way to think systematically about controls. Let's look at a widely recognized framework that guides internal control, and then let's connect it directly to one of the most talked about and maybe least understood technologies of our time: blockchain. This is really where we can see how those traditional control concepts we've been discussing are being applied, or maybe need to be rethought, in the face of these new digital frontiers. It's about bridging the old and the new to ensure trust and accountability.
Exactly. And when we talk about widely recognized frameworks for internal control, the first name that almost always comes up is COSO. COSO stands for the Committee of Sponsoring Organizations of the Treadway Commission. It's a joint initiative of 5 private sector organizations dedicated to providing thought leadership through the development of frameworks and guidance on enterprise risk management, internal control, and fraud deterrence. Their most famous work is probably the Internal Control Integrated Framework, often just called the COSO framework. It's used by countless organizations worldwide to design, implement, and assess the effectiveness of their internal controls. The framework is built around 5 interrelated components: control environment, risk assessment, control activities, information and communication, and monitoring activities. Within these 5 components, there are 17 underlying principles. Now, while the entire framework is relevant, 2 components and a few specific principles within them are particularly pertinent when we think about establishing robust internal control over information technology, IT systems like the ERP and AIS we've been discussing.
Okay, which ones are most relevant for IT?
First, within the control activities component, Principle 11 is key. It explicitly states that the organization selects and develops general control activities over technology to support the achievement of its objectives. This means really understanding the deep dependency between these general IT controls, like access controls, change management controls, IT operations controls, and how technology is actually embedded within critical business processes. Organizations must establish clear, effective controls over their entire IT infrastructure, their security management practices, and their processes for acquiring, developing, and maintaining technology. It's about building safeguards directly into the tech backbone itself. Second, the information and communication component is crucial. Principle 13 emphasizes that the organization obtains or generates and uses relevant, quality information to support the functioning of its internal controls. This involves clearly identifying the company's specific information needs for control purposes, ensuring the capture of relevant data, both internal and external, processing that data into truly useful information, accurate, timely, accessible, and maintaining the quality and integrity of that information throughout its life cycle. You need good information about your controls and the processes they monitor.
Makes sense. Garbage data in, garbage control out.
Precisely. Then, Principle 14 within the same component focuses on the effective internal communication of information necessary to support internal controls. This includes communicating control responsibilities, deficiencies, and other relevant internal information to the proper stakeholders across the organization, including senior management and the board of directors. It also stresses the importance of having communication lines that are separate from direct management channels, like a whistleblower hotline reporting to the audit committee for independent oversight. And it involves carefully selecting the most relevant and effective methods for all this communication. Together, these principles provide a solid roadmap for building a trustworthy, transparent, and well-controlled IT environment that supports the business's objectives.
Can you give an example of how a company might apply these specific COSO principles to improve their IT controls and practice?
Sure. Let's imagine a hypothetical spinal surgery clinic, SSCTA, a large physician group practice. Let's say their board of directors, concerned about data security and operational efficiency, commissioned an IT audit which recommended strengthening controls based on the COSO framework. So, to address Principle 11, General Controls Over Technology, SSC might invest in new security technology. For instance, they could implement multi-factor authentication, MFA, for all users accessing electronic patient health records, EHRs, going far beyond just a simple password to verify user identity more robustly. To tackle Principle 13, using quality information, SSC might adopt a sophisticated data cleansing system. This system would automatically identify incorrect errors or inconsistencies in patient demographic and clinical data before it's used for billing or clinical decision support, thereby ensuring they acquire and use error-free data, which directly enhances both patient outcomes and billing accuracy. And to improve based on Principle 14, internal communication, SSC might institute regular formal reviews of key IT functions, like system access logs and change management processes. They could also begin issuing concise, monthly internal control performance reports directly to the Board of Directors Audit Committee, ensuring transparent oversight and accountability for IT controls. This example shows how a framework like COSO isn't just abstract theory. It provides concrete principles that organizations can actively apply to make tangible improvements in protecting sensitive data, like patient records, and ensuring the operational excellence of their critical IT systems.
That's a great practical illustration. It provides a solid foundation for understanding established control frameworks. Now let's pivot, because this is where it gets really interesting. Let's talk about blockchain. This technology seems to totally change the game for how we think about records, trust, and ultimately controls. It feels like it introduces a fundamentally different paradigm.
Blockchain truly is a revolutionary technology, you're right. And it absolutely challenges many traditional assumptions about data integrity, trust, and control. Its origins, as most people know, lie in being the underlying control system, the ledger technology. For Bitcoin, the first major digital currency, or cryptocurrency, launched back in 2009. The process, often called Bitcoin mining, involves participants on the network competing to solve complex mathematical problems using cryptography. The purpose of solving these problems is to validate and confirm batches of recent Bitcoin transactions. The reward for the first miner to successfully solve the puzzle and have their solution validated by the network is twofold. They receive newly created Bitcoin, and their validated block of transactions gets added to the growing chain of previous blocks. The fundamental problem that this ingenious mining and consensus mechanism inherently solves is preventing the double spending or unauthorized copying altering of the digital currency, essentially, eliminating the risk of counterfeiting in a purely digital realm. It also programmatically limits the initial creation of Bitcoin to a finite predetermined number, ensuring scarcity.
Okay, so it started with Bitcoin, but the underlying technology, the blockchain itself, has value beyond just cryptocurrency, right? What are its key characteristics from a control perspective?
Absolutely. The underlying blockchain technology has several key attributes that are incredibly relevant from an internal control and auditing perspective. 3 stand out. First, its incredible resistance to alteration. Once a block of transactions is validated and added to the chain, it becomes computationally infeasible to change or delete it without altering all subsequent blocks, which would require an impossible amount of computing power on a large, established blockchain. Each new block is cryptographically linked to the one before it, creating this immutable, tamper-evident history. This allows anyone with access to view all the blocks right back to the very beginning of the chain, the Genesis block. This inherent feature functions as a powerful built-in audit tray. Second is the concept of multi-party transaction validation, which is achieved through the network's consensus mechanism, like Bitcoin's proof-of-work mining. Transactions aren't validated by a single central authority, but by a distributed network of participants following agreed-upon rules. This reduces reliance on a single intermediary and distributes trust across the network. Third is its potentially decentralized nature. Many public blockchains, like Bitcoin or Ethereum, are designed to operate without a central administrator or controlling entity. Control is distributed among the network participants.
That built-in audit trail sounds incredibly powerful for auditors.
It is. For blockchain users, and especially for service auditors performing SOC2 engagements on systems that utilize blockchain, this immutable ledger is incredibly valuable. An auditor can use the blockchain itself to help verify transactions by validating cryptographic signatures, checking immutable timestamps, and tracing the flow of assets between wallet addresses recorded on the chain. A service auditor can also focus on verifying the security controls around the nodes participating in the network and the supporting IT infrastructure to enhance assurance over the physical or virtual integrity of the blockchain environment being assessed. However, and this is a key challenge we need to acknowledge, often not all the data needed to fully understand and validate a business transaction resides directly on the blockchain ledger itself. Sensitive off-chain data like the real-world identity, personal information linked to a pseudonymous wallet address, or detailed business context about a supply chain transaction still needs to be managed, secured, and considered by auditors. The blockchain might only hold part of the story.
And what about that decentralized nature? You said it's partially detached from government control.
That's often highlighted as a core feature, especially for public permissionless blockchains like Bitcoin. They aim to operate across borders with less direct interference from any single government or traditional financial institution. However, it's crucial to clarify that this doesn't mean they operate in a complete regulatory vacuum. Many nations do heavily regulate activities related to cryptocurrencies. They might regulate the fiat to crypto exchanges, impose Know Your Customer, KYC, and anti-money laundering AML requirements, tax crypto gains, or even, in some cases, ban certain types of cryptocurrencies or activities altogether. Some jurisdictions are also moving towards requiring certain digital assets to be registered and treated as securities, subjecting issuers and exchanges to the same kinds of regulations as traditional stock markets. So, while decentralization offers a new kind of operational freedom, it doesn't grant complete immunity from regulation. The regulatory landscape is complex and constantly evolving globally.
Okay, this is fascinating. Blockchain inherently builds in some really powerful control features like that unalterable audit trail right into its core technology. That seems amazing. But if we connect this back to the bigger picture we were just discussing, how does this new, often radically decentralized technology, which might have no single central authority, actually fit into an established, arguably more hierarchical control framework like COSO? It really does feel like trying to fit a square peg into a round hole in some fundamental ways. This must create some truly unique challenges for traditional auditing and assurance, for establishing oversight and accountability.
You've absolutely hit on the radical truth that blockchain forces us to confront, and it highlights this incredibly dynamic, sometimes tense, interplay between technological innovation and the need for established assurance mechanisms. Blockchain technology fundamentally transforms traditional record-keeping. By recording transactions with potentially minimal human intervention directly onto an immutable shared ledger, it inherently builds in a high degree of record integrity and transparency. As you said, this eliminates or significantly mitigates certain traditional risks, like the risk of manual data entry errors, unauthorized alteration of records after the fact, or disputes arising from different parties having different versions of the truth. However, and this is the crucial balancing point, while it solves some old problems, it simultaneously introduces entirely new risks and significant challenges for applying traditional control frameworks like COSO, especially in its purest, most decentralized forms.
What's the biggest challenge when trying to apply CSO to, say, a public blockchain?
The single biggest conceptual challenge stems directly from the core principle of decentralization. In a truly decentralized public blockchain, a single participating organization simply won't have complete, unilateral control over the entire network or its operations. The organization is intertwined with, and dependent upon, numerous other independent participants, and the collectively enforced protocol rules. There's typically no single centralized management entity overseeing the blockchain's day-to-day activity in the traditional corporate sense. This means there's no single entity that can be held fully accountable in the way COSO typically envisions if something goes wrong with the network itself. This decentralization presents a unique auditing challenge as well. An auditor can't simply engage a traditional SOC auditor to get assurance over the internal controls of the entire Bitcoin network, for example. It doesn't work that way.
Organizations building applications on top of public blockchains or using private consortium blockchains need to find alternative ways to gain assurance over the relevant controls, perhaps through focused audits of their own nodes and interfaces, cryptographic verification methods, or reliance on the inherent security properties of the underlying protocol itself.
So the traditional audit model struggles with true decentralization. But are there still benefits for financial reporting even with these challenges?
Oh, absolutely. Despite the control challenges, blockchain technology offers potentially significant benefits for financial reporting processes. Its shared, transparent nature can dramatically increase the visibility of transactions and the availability of reliable data to authorized participants in near real time. This allows management to more easily and robustly support the assertions underlying its financial records, like existence and valuation. As we discussed, audits of transactions recorded on a blockchain can be inherently easier and more efficient in some respects due to those automatic immutable audit trails. And ultimately, this can enable management to provide financial information to stakeholders faster and potentially more effectively than traditional batch process systems allow.
So how should an auditor, maybe doing a SOC2 engagement for a company using blockchain, think about applying COSO and the trust services criteria in this new context?
It requires careful consideration. In a SOC2 engagement involving blockchain, the service auditor should still systematically consider all 5 trust services: criteria, security, availability, processing integrity, confidentiality, and privacy, as they relate to each of COSO's 5 internal control components: control environment, risk assessment, etc. They need to ask probing questions. For instance, regarding processing integrity, is the way transactions are validated and added to this specific blockchain ledger sufficient to meet the standards required by COSO's control environment, specifically Principle 4, which demands commitment to competence? Can the potentially anonymous or pseudonymous participants in a decentralized consensus mechanism reliably demonstrate the competence expected in a traditional control framework? That's a tough question. Right. It sounds like there might be gaps where COSO's traditional assumptions just don't map neatly onto decentralization.
That's precisely the tension. For most truly decentralized permissionless blockchains, it's likely that certain traditional COSO control components might not be fully met in the conventional single entity sense. Particularly challenging are Component 2. The organization exercises oversight responsibility. Who is the board overseeing the entire Bitcoin network? Component 5. The organization holds individuals accountable. Who do you hold accountable if the decentralized network experiences downtime or a flaw is exploited? The reason is simple. True decentralization inherently distributes accountability and oversight across a potentially vast network of participants. There isn't one single individual or a small, identifiable group dictating policies and holding ultimate responsibility in the way COSO envisions for a single corporation. This reality means that service auditors may need to adjust their perspective on how certain control objectives are achieved in a blockchain context, maybe focusing more on the protocol's inherent properties than on human procedures.
Or, in some cases, they might need to restrict the scope of traditional SOC2 engagements to organizations that utilize more centralized or permissioned blockchains, like private or consortium chains, where traditional oversight structures and accountability mechanisms are more clearly defined and applicable.
But COSO can still be a useful lens, even if it needs adaptation.
Absolutely. COSO still provides an invaluable framework and a common language for thinking about and evaluating the risks related to blockchain technology, even if the implementation of controls looks different. COSO has actually published guidance on applying its framework to blockchain. Across its 5 components and 17 principles, it prompts critical thinking. For the control environment, how should boards adapt codes of conduct for blockchain? How can they enhance their understanding of blockchain's uses and risks? How should responsibility and authority be defined for blockchain solutions, possibly using cross-disciplinary teams? How do we reevaluate necessary competencies? And crucially, how do we enforce accountability, maybe focusing on who controls access, like private keys, for risk assessment? What are the specific objectives for using blockchain, for example, ensuring verifiable financial records? How do we develop robust risk assessment processes before jumping into implementation? Should we engage IT and blockchain specialists to identify unique fraud risks? And how do we use strong change control processes when deploying or amending blockchain solutions or smart contracts? For control activities, what general and specific controls are needed over critical technical aspects like the security of nodes, the integrity of consensus protocols, the safeguarding of private cryptographic keys, and the testing and security of smart contracts? What new policies and procedures are needed to address internal controls, emerging risks, and the unique accounting implications related to blockchain assets and transactions? For information and communication, how can we use advanced data analytics to get relevant quality data off the blockchain to meet management's objectives? How do we educate internal stakeholders effectively? How do we develop clear communication methods for operational changes? And should we engage external auditors early during application development? And finally, for monitoring activities, Given the potential volume and speed, should we implement computerized continuous monitoring techniques? How do we perform ongoing evaluations to detect changes in the technology or risks? And how do we identify the right talent to spot changes, correct deficiencies promptly, and communicate them effectively?
So, CISO provides the right questions to ask, even if the answers look different in a blockchain world. Are there specific types of controls that become more important?
Yes, the nature of blockchains suggests some shifts in emphasis. Given the speed and potential irreversibility of blockchain transactions, there should likely be a stronger focus on preventative controls. Controls designed to stop errors or unauthorized transactions before they get onto the immutable ledger. Conversely, because detecting issues after the fact might be harder to correct, organizations should probably increase the frequency and sophistication of their detective controls to spot anomalies or problems as quickly as possible. It's also advisable to develop controls that leverage advanced analytic technologies themselves. For instance, using AI tools, perhaps even large language models, LLMs, which are proving adept at quickly identifying potential bugs or security vulnerabilities in smart contract code before deployment. Furthermore, companies operating in this space absolutely need to develop a clear code of conduct related to digital assets and establish robust policies and procedures to comply with relevant regulations like Know Your Customer, KYC, and Anti-Money Laundering, AML, which are crucial for regulatory compliance, especially when dealing with cryptocurrencies. And lastly, given the complexity, creating cross-disciplinary teams involving IT, security, legal, compliance, finance, and operations with strong segregation of duties and clear reporting lines, and clearly identifying all users and entities participating in the creation and maintenance of the blockchain application, especially in permission settings, is crucial for effective governance in this new, often decentralized landscape.
This really brings up a crucial point, doesn't it? It seems like while blockchain promises and often delivers incredible levels of integrity, immutability, and transparency right into the technology's fabric, it also fundamentally demands new ways of thinking. It requires significant adaptations in how we apply our traditional frameworks for oversight, accountability, and control. It's clearly a truly dynamic interplay between groundbreaking innovation and the enduring need for assurance, where the old rules of the game are constantly being tested and rewritten by the technology itself. Hashtag tag outro.
Wow, what an absolutely packed, exhilarating deep dive today. Seriously, my head is spinning a little bit in a good way. We started by really cutting through the noise, didn't we? Getting a clear understanding of the fundamental difference between those big ERP systems and the more focused AIs, unraveling how these foundational systems create the intricate digital backbone of practically every modern business.
The nervous system, as we called it. Exactly. Then we peeled back the layers, looking at how those critical transaction cycles, revenue, purchasing, payroll, and all the others actually operate within a business, guided by that precise sequence and the unshakable audit trail ensuring traceability. We explored the big strategic approaches companies use for improvement automation, shared services, outsourcing, and then dove into some really cutting-edge technologies like RPA, NLP, and those brain-like neural networks that are supercharging these systems and truly transforming the way work gets done.
Changing the nature of jobs, really.
For sure. And finally, we grappled with that absolutely crucial challenge of ensuring processing integrity, making sure we can trust the data. We looked at how that's done through traditional auditing, checking designs and operations, and then faced the fascinating challenge of adapting established frameworks like COSO to revolutionary decentralized technologies like blockchain. Hopefully you're walking away today feeling, oh, not just like you got a shortcut to being well-informed, but with a genuine appreciation for this intricate, often invisible, digital circulatory system that underpins our entire global economy. It's truly amazing how carefully these systems have to be designed, managed, controlled, and constantly evolved to maintain that essential accuracy and trust.
And if we just connect all that back to the bigger picture, I think it really highlights a key theme. Well, technology, whether it's automation, AI, or even inherently secure distributed ledgers like blockchain, can automate processes, enhance integrity, and solve all problems. That critical human element remains absolutely paramount. The intelligent design of systems, the thoughtful implementation of controls, the continuous adaptation to new risks and technologies, and the ultimate oversight and accountability, those still rely fundamentally on people. So maybe the provocative question to leave everyone with is this. As these systems inevitably become even more complex, more interconnected, and potentially more decentralized, how will we collectively as businesses and society continue to ensure accountability and maintain trust in a world awash in ever-increasing data empowered by ever-evolving, sometimes opaque technology.
That is a powerful and frankly essential question to leave you all mulling over. It really gets to the heart of the future of business, technology, and trust itself. We sincerely hope this deep dive has sparked your curiosity, maybe answered some questions, and definitely given you plenty to think about. Until next time on the deep dive, keep digging into what fascinates you.